Hello friends. The topic of today's video is a question I've been asked by a lot of people over the past few years. Suppose you have 1 lakh rupees to invest. Which one should you go for? A mutual fund lump sum investment or stock market, that is directly shares? Let's discuss in this video. Welcome to AAarthiB Tax Info. So in the table that you're going to see, I've taken a 10-year period and I'm comparing 4 different types of stocks with a mutual fund lump sum investment. Penny stock, small cap stock, mid cap stock and large cap stock. I've listed down the share price of all the stocks in August 2014. The amount invested will be 1 lakh, and I've also given the current share price. I'm shooting this video on 20th of August. So the share prices that you see are the share prices as on 20th of August 2024. And the other column is the value as on date. And the last column gives you the gain from the respective investments. So if you look at the first row, it is Tata Motors Limited. It's a large cap stock. The share price in 2014 August was 506.03. Amount invested is 1 lakh. The current share price is 1083.3 and the current value comes to 2,14,078. The gain would be 1,14,078. Next one would be Castrol India Limited, a mid cap stock. The share price in August 2014 was 179.05. Amount invested is the same 1 lakh. Current market price is 251.9 and the current value would be 1,40,687 with a gain of 40,687. The third one is a small cap stock, JP Infratech Limited. You must have all heard of the JP Group. Now this is, I've taken this example to make you understand that anything can happen when it comes to a stock. Either it can be a multi-bagger or it can go to zero also. So the share price in August 2014 was 34.05 rupees. Amount invested is 1 lakh. And right now, if you see, the share price is zero. The reason is because it is not listed in the market anymore. The company went bankrupt. So whatever you invested 10 years back, the value is zero now. Your entire investment is gone. The next example is Porval Auto Components Limited. It's a penny stock. Penny stock is any stock whose value is less than 10 rupees. So if you look at this example, the value in August 2014 was 7.9 rupees and right now it has rocketed to 67.69 rupees and the current market value is 8,56,835 rupees and the gain would be 7,56,000 odd rupees. Now at the bottom of the table, I've given a note which tells how dangerous penny stocks could be, because generally 90 to 95% of the penny stocks that you invest in goes to zero. The value goes to zero. So this example and this video is not a recommendation for you to go for penny stocks. Generally, it's best avoided. The reason I've included it in this video is only to give you a comparison. And the next one in the table would be a lump sum investment of 1 lakh rupees in mutual fund, which gives you a 12% growth per annum. So if you look at it, the amount invested in August 2014 would be 1 lakh and the current value would be 3,10,585. The last example would be the same 1 lakh investment in lump sum mutual fund. The growth rate is 15% per annum. That would give you a return of 4,04,556 rupees with a gain of 3,04,556 rupees. So what is the criterion for deciding which one you should be going with? Is it the gain that you're making out of the investment? If that is the case, as per this example, you should be going for the penny stock, that is Porval Auto Components Limited. But is that the criterion? Definitely not. So how should you make an assessment before making an investment, whether it should be a lump sum mutual fund investment or a particular share? Let's discuss that in the final part, which is the takeaway section. Takeaway number 1. A lot of people are so stuck upon getting the next multi-bagger stock. A multi-bagger stock is any stock that gives you manifold returns. For example, you bought a stock for 50 rupees and the price rises to 250 rupees or 500 rupees. That is what you call a multi-bagger stock. But if you are getting 10 stocks, if you're picking 10 stocks and 3 or 4 out of them are turning positive, that's giving you profits, you can call yourself lucky. That is a general trend. And even if you have a multi-bagger stock among these 10 stocks that you've picked, you have to take into account the return of the entire portfolio. Sometimes the losses from the remaining 6 or 7 would offset the gains made from this multi-bagger stock. So this entire portfolio returns has to be compared with the mutual fund lump sum investment. The other interesting thing is that the general public like you and me would only come to know of a multi-bagger stock after it becomes a multi-bagger stock. The people in the industry, the experts, they do a lot of analysis and they get to know at the early stages of a company whether it has the potential to become a multi-bagger or not. Unfortunately, the majority of people who invest in the stock market don't have that capability. Also, if you look at the table that I had given, famous stocks like Tata Motors and Castrol Limited gave you returns much lesser than that of the returns given by mutual fund lump sum investments. Mutual fund lump sum investments gave you 2x to 5x returns when compared to Tata Motors and Castrol Limited. Point number two, if you already have a multi-bagger stock in your portfolio, fine. But if you don't have any multi-bagger stock in your portfolio till now, you have some serious thinking to do. Point number three, in the case of a mutual fund lump sum investment, whatever reallocation has to be done, it will be taken care by the fund manager. But in the case of a stock, if the one you have chosen hasn't performed well till date, or it is not performing well, whatever it is, you have to keep constant track of what's happening. And if it's giving you negative returns, you have to sell it and buy a better stock or a different stock. And the final and the most important point is that the majority of people fail to notice the reinvestment part, which helps you with the compounding. I'll explain in detail. When it comes to a stock, the investment that you make will give you dividends at regular intervals as and when the company is declaring a dividend. Now, if you want the compounding to happen, you have to reinvest this amount back into the stock. But this is where it gets tricky. The two difficulties that you face in this is, one is you might forget, you might be busy with your work, or you might not be interested in reinvesting, or you might be requiring that money for something else. The second difficulty is that suppose the dividend that you get is only 100 rupees and the share price of that company is around 250 rupees. Then in this case, you can't reinvest because you can't buy a quarter of a share or a portion of a share. It has to be at least one share. So in this case, you can't reinvest. But if you're in the case of a mutual fund, if you have chosen the growth option, growth kind of mutual fund, whatever returns are getting generated, they automatically get reinvested into the mutual fund, thereby resulting in compounding. So this compounding is what gives you much better returns in the long term. So once you consider all these points, I leave it up to you to decide which one to go for. If you are confident that you have the ability to get a multi-bagger stock or a stock which gives you manifold returns in comparison to a mutual fund, then you can go for that. But if you want to play safe, or if you want to get the best returns out of the stock market and at the same time keep your risk at a moderate level, then you should go for a mutual fund lump sum investment. I hope this video gave you some clarity. If you have some queries, please give them in the comment section and we'll be happy to reply. I'll see you in the next video. Thank you.